Alright, let us quickly recap the foundation of this topic. Management accounting exists to serve internal users, the managers and decision-makers inside an organization. Unlike financial accounting, which reports historical results to external stakeholders under strict regulatory frameworks, management accounting is flexible, forward-looking, and tailored to support planning, control, and decision-making. It covers everything from cost analysis and budgeting to performance measurement, using both financial and non-financial information. With that foundation in mind, let us now look at the exam questions together. Question 1. Read it carefully. Which of the following best describes the primary purpose of management accounting? Two key words here: best, meaning one option is clearly more complete than the others, and primary purpose. So we're looking for the fundamental reason management accounting exists, not a side effect of it. Option A mentions IFRS and external shareholders. Alarm bells should ring immediately. That's financial accounting territory, not management accounting. Option C is about statutory and tax compliance. Again, that's external reporting. Option D is about double-entry bookkeeping. That's bookkeeping, the recording function, not management accounting's purpose at all. Option B is the one that mentions internal managers, planning, control, and decision-making. And notice it says financial and non-financial information. Which one is it? The answer is B. Management accounting's entire reason for existing is to give internal managers the information they need to plan, control operations, and make decisions. That's it. And critically, the definition includes non-financial information, something options A, C, and D completely ignore. Why are the others wrong? A describes financial accounting, external users, IFRS compliance. C is about compliance and tax. Again, external regulatory focus. D is about bookkeeping. Recording transactions is a function of financial accounting, not management accounting's purpose. Common mistake. Students who haven't studied yet guess because they associate accounting with IFRS. Now you know better. Question 2. Which statement about management accounting is correct? The word correct here means one statement is fully accurate and the other three contain at least one false element. Your job is to identify the false element in the wrong ones. Take a moment to read each option. Look for the word in each one that might be incorrect. Option A says management reports must comply with IFRS and be audited. Both parts of that are false, so A is out. Option B says management accounting uses exclusively monetary measures. Exclusively is the danger word there. We know it includes non-financial measures, so B is out. Option C says management accounting is primarily historical. It's actually primarily forward-looking, so C is out. That leaves D, flexible and designed around the organization's specific needs. That is precisely the defining characteristic of management accounting. The answer is D, flexibility, no mandatory format, no IFRS, no audit, is the hallmark of management accounting. It bends to fit the organization, not the other way around. A is wrong on 2 counts. Neither IFRS compliance nor audit applies to management reports. B is wrong because management accounting explicitly includes non-financial measures, cycle time, customer satisfaction, staff turnover. C is wrong because the primary time orientation of management accounting is forward-looking, budgets and forecasts, not historical records. Key takeaway. Whenever you see the word exclusively or must comply with IFRS next to management accounting, those are almost certainly wrong. Question 3, a scenario question. A divisional manager requires a weekly report showing actual production costs compared to budgeted costs. Before you look at the options, ask yourself, what kind of information is this? It's weekly, so frequent. It's actual versus budget, so detailed and operational. It's production costs, very specific and granular. Now look at the options. Which management level fits that profile? Option A says strategic level, but strategic managers deal with long-term, broad data. A weekly production cost report is the opposite of that. Option B says supervisory level. This isn't one of the 3 standard management accounting levels we use in ACCA. so it's a trap for students who haven't studied the framework. Option D says external reporting level. This is an internal report, so D is immediately wrong. That leaves C, operational level, which matches perfectly: short-term, detailed, frequent, activity-specific. The answer is C, operational level. Weekly variance reports are the textbook example of operational level information. Short-term, highly detailed, frequent, designed to enable immediate corrective action on the factory floor or in the production department. Strategic level is wrong because it deals with multi-year decisions and broad external trends, not weekly production cost variances. Supervisory is not a standard ACCA management level classification, it's a distractor. External reporting level is wrong because this is entirely internal information. It never leaves the organization. Key takeaway: match the time horizon and detail level to the management level. Weekly and granular equals operational. Question 4 is testing something specific. Do you actually know what non-financial means? The question asks for a non-financial measure. So before reading the options, be crystal clear. Non-financial means not expressed in monetary or percentage terms derived from money. It's a qualitative or quantitative measure that doesn't use a currency unit. Option A is gross profit margin as a percentage of revenue. This is derived from financial figures, so it's financial. Option C is total cost of inventories. That's in dollars, so it's financial. Option D is budget variance in monetary terms. The word monetary gives it away. Option B is a customer satisfaction score out of 10. No currency, no financial calculation, purely a qualitative rating. That's your non-financial measure. The answer is B, customer satisfaction score rated out of 10. It contains no monetary value whatsoever. It measures something real and important, how happy customers are, but it does so without a single dollar sign. Option A, gross profit margin. Even though it's a percentage, it's calculated from revenue and cost figures, so it remains a financial measure. Option C, inventory cost, is straightforwardly monetary. Option D, budget variance in monetary terms. The question literally tells you it's monetary. The exam will test this distinction repeatedly. Non-financial means no money. Think satisfaction scores, delivery times, defect rates, staff turnover percentages calculated from headcount rather than salary. Question 5, the cost-benefit principle. This is testing a concept, not a calculation. Read the question carefully. The cost-benefit principle in management accounting states that you need to find the option that accurately describes this specific principle. Watch out. Options A and C sound like they're about accounting matching concepts, which is a completely different area. Option A talks about costs being reported in the statement of profit or loss. That's an accruals and matching concept from financial accounting. Nothing to do with the cost-benefit principle. Option C is about matching cost of goods sold to revenue in the same period. Again, that's the matching principle in financial accounting. Option D says non-financial information should never be produced. We know that's completely wrong. Non-financial information is essential. Option B is the only one that describes a management accounting system design decision. Only produce a report if its value exceeds its cost. The answer is B. The cost-benefit principle is simple but powerful. If producing a management report costs your analysts 20 hours of work per week, but the report only saves the company the equivalent of 10 hours of poor decisions, it's not worth producing. The benefit must exceed the cost. That principle governs how management accounting systems are designed. Option A is the accruals concept, recognizing costs in the period they're incurred, not when cash moves. Option C is the matching principle, aligning revenue with the costs that generated it. Both are financial accounting concepts, not management accounting system design principles. Option D is the opposite of the truth. Non-financial information often has enormous value precisely because it can't easily be quantified. The exam trap here is confusing cost-benefit with matching. They sound similar, but are completely different principles. Short question 6. 4 marks for identifying and explaining 2 differences between management and financial accounting. The mark scheme is 1 mark for identifying the difference, 1 mark for explaining it, twice. So structure matters. Don't just list 2 words. Explain the implication of each difference. Think about regulatory framework, time orientation, users, or measurement types. Any 2 from those 4 will earn you full marks if you explain them clearly. A model answer would look like this. First difference, regulatory. Financial accounting must comply with IFRS and statutory requirements, meaning the format and content are legally prescribed and independently audited. Management accounting has no mandatory format and requires no audit, so organizations design reports freely around their own needs. Second difference, time orientation. Financial accounting records historical transactions that have already occurred. Management accounting is forward-looking, producing budgets and forecasts to support future decisions. Each point, 1 mark for the contrast, 1 mark for the explanation. For marks total. Short question 7. 2 marks for explaining why timeliness matters more than precision in management accounting, plus 1 practical example. The mark scheme splits it neatly. 1 mark for the concept, 1 mark for a valid example. Think about it from the manager's perspective. What happens if you get perfect information too late? Here's how to answer this for full marks. Concept mark. Management decisions often have a time window. If information arrives after that window closes, it has no decision-making value regardless of its accuracy. So approximate information available now is more useful than precise information available later. Example mark. A production supervisor receives an estimated cost overrun report at the end of the week and can immediately reschedule production to reduce waste. If they had waited 3 weeks for a fully reconciled, precise figure, the overrun would have continued unchecked, making the precise report worthless for control purposes. That's 2 marks. Concept plus concrete example. And that wraps up topic A1. 3 things to take away. 1. Management accounting serves internal managers. Financial accounting serves external users under IFRS. 2. Management accounting is flexible, forward-looking, and includes non-financial measures. 3. The cost-benefit principle governs what gets reported. In the next topic, A2, we move into sources of data. Where does the information in management accounting systems actually come from? And how do we classify it? See you there.